So welcome to the Client Review Workshop. This is a new initiative that we have started at Efficient Portfolio, because what we were finding was that in our one-to-one client meetings, we were repeating the same message regularly in terms of when we've got a centralized investment approach, as we have using portfolio metrics. We were obviously talking about the investment performance in the markets regularly with clients and repeating the same messages time and again. But not only that, we were also being asked the same questions in terms of legislation changes, opportunities. And combined with that, what we were finding is that we wanted to cram more and more stuff into the client review, but we didn't have sufficient time to cover everything that we wanted, both from a performance and opportunity point of view, but also from a one-to-one point of view in terms of what's specific to your situation. So what we've been rolling out as part of the progressive review program is to section the two bits out. The first bit, it should be about explaining the performance, opportunities, market changes, those sorts of things, changes across our business. And then the second bit, which is what we're doing through the client review workshop, and then the second bit should be about the one-to-one meeting that's specific to your situation. So this is not in replacement of the one-to-one meeting, but that one-to-one meeting can then look like it can look different for different people, and even different for the same person but in different years. So some years that might be 1 or 2 telephone calls. Another year that might be 1 or 2 face-to-face meetings. Whatever is then right for your specific situation, having covered all the essentials. So that's really why we wanted to introduce the client review workshop. Now, we sent you prior to the workshop a preparation pack, and some of you have sent that back, and some of you haven't sent that back. If in previous years we've sent you this review pack in the hope that you would send it back, but we were pretty relaxed as to whether we got it, because on a one-to-one basis, in a one-to-one meeting, we can obviously ask the questions and fill in the gaps and then make the recommendations that are appropriate there and then. When we're starting to introduce the client review workshop, though, because we're wanting to get communicate with you in a far more effective way, we really need those preparation packs back. We've let you off this year because it's a new concept. So if you haven't done your homework, we weren't nagging you. But next year we are going to need those back, because you will see as we go through this process that it really impacts the amount of work that we can do for you on your own review pack. So I would encourage you to complete that next year, and in fact next year we will nag you if we haven't had it back, because it just means that we can do this far more effectively. Now, you should have had from either Alex or Tim sent you your review documents, and within that there's a few different pieces, some of which will be familiar, some of which are a bit new. And the first port of call is the Efficient Portfolio Summary, which is something that you should be pretty familiar with. We've been using a similar page to this for quite a long time. And this document here is really, the idea is it's a 1-2 sometimes, because it sometimes rolls onto 2, but it's a 1-page summary of everything that we look after for you. So if you've got, and it'll look something similar to this, if you've got investment in protection, so life insurance, critical illness cover, that sort of stuff, then that will all feature here. And in addition to that, you'll have, for any protection policy that you've got, we'll usually quote an alternative policy based on the same terms to see if we could get the same cover for a lesser premium. If that's come out cheaper, then, and we'll come on to recommendations later on, then we'll put in the recommendations that you could be changing that. We then come on to the investments, value as of last year, current value, we've got whether you've funded ISA allowances for this year or not, and then we've got the pensions that you've got, plus any wills and trusts that we've set up for you. So that page just really gives you a stock take, it gives you the opportunity to just see where you are at the moment. As I say, we've done that for you each year as part of your review process. So I want you now to open the investment performance report, which will have been sent to you as a separate document. And you should be fairly familiar with this document because this is similar to the one that we send you on a quarterly basis, except this is a longer version of that document. So I'll explain how it differs as we go. But if you could open up that document and we can then wander through the specifics. And what I'm going to do is I'm going to use this as an opportunity not only to talk to you about what's going on in the world and what's going on in the portfolios and whether we think it's going well or not, but also I'll use this as an opportunity to explain how we how you can best extract the content of that report that we send you quarterly so that you can really just whistle through that report but get everything that you need out of it very quickly. And you can spend 30 seconds looking at it and still see whether the portfolio is working well for you, or you can spend 15 minutes reading it if you prefer. So hopefully you've had a chance to open that up. And if you go through, initially there's some text, which is the market commentary from Portfolio Metrics, what's happening with the different sectors. But I'd like to concentrate and draw your attention to the first chart, which looks something along the lines of this. And this chart will feature in this report. Now, ultimately, you can just focus on the screen now. You don't have to look at your own versions of this report. But if you've got a big enough screen or two screens, if you're really well organized, then you might want to pull your chart up at the same time. But this chart is not looking at anything specifically related to you. It's looking at the asset classes in general. So these are all of the different asset classes that we can invest in. Different types of bond, different types of stocks and shares, property and commodities. And this shows you what the performance has been like over the last year, the year before that, and also the last quarter. So what you can see, and when you look at this chart, use this as kind of a barometer to say, well, if everything's pretty much up, you can expect the performance to be pretty much up on the portfolio. If everything's pretty much down, or a lot of them are down, then you can expect the performance to be poorer. And what you can see is that last year and last quarter were both pretty positive time frames. 2015, less so, particularly for commodities, but still pretty good. And so that would say that, there's a decent prevailing wind, and if all the asset classes are going in the right direction, you'd expect the portfolios to be doing the same thing. Now, you're invested in pretty much all of these sectors with the exception of commodities. Commodities are gold, oil, etc. Now, that looks like a bad decision in 2016, and that's really because the oil price rebounded a bit from a horrible 2015. And we keep discussing whether commodities should be or put into the portfolio. It's been absolutely the right thing to keep them out of the portfolio from the majority of the last 4 years. But I still am in conversation with Portfolio Metrics as to whether we should be bringing commodities back in now. Their problem is not just whether it's the right time, but also they're not very happy with the mechanism with which we get access to commodities. Typically, that's through things like exchange-traded funds known as ETFs, but they're just not happy with the way that ETFs relay the gold price and all of those sorts of things. And plus, they rightly point out that the FTSE 100 is made up of lots of companies that are very directly exposed to commodity prices. So, for example, if oil goes up, then a lot of the FTSE will go up because it's related to oil prices. So you do get an indirect exposure to commodities, even if you don't hold them directly. So this chart is just useful to look at every quarter, just to give you a sense check as to what's going on out there in the market. So the next place I want, so what I want to then say is, well, really, that the FTSE 100 obviously has done extremely well over the last year. You can see that in this time frame, and this was February through to end of January. So February 16, so 1 year, the performance has delivered directly from the FTSE 100 of about 27%, which has been quite astonishing. Now, that is in large part due to the referendum result. And as a result of the referendum result, that we saw a weakening in the pound, and because of that, we've seen companies that report their profits in dollars, which actually is quite a large number of companies in the FTSE 100, they instantly become more profitable with a weaker pound. So that has impacted the FTSE. So a bit of that growth is almost false growth, but that doesn't mean it's going to necessarily go the other way. What's interesting though is when we look at the FTSE 100 compared to the world index. So the green line is the world index, and the orange line is the FTSE 100. And you can see that the world has actually been growing better and faster than the FTSE 100 has. That only looks important when you look at the 20-year time frame. So over the last 20 years, you can see that really those two indexes have been pretty much together for the whole time, starting to open up a little bit in 2013, but really that difference has opened up quite a lot in recent years. So that to me indicates that there's still more growth possible for the FTSE 100. Either that or the world market has overshot a little bit and could well come back. But either way, that gap looks like something that's likely to correct itself. And it's also worth bearing in mind that you're not invested directly in the FTSE 100. You're invested in a much more diverse portfolio. So the purple line here is the diverse portfolio. It's portfolio 5, which is about 63 on the risk scale. We tend to use portfolio 5 as the most common comparator, just because we have a lot of clients that are based around that level of risk. But you can see that over that 3 years, the diversified portfolio has given you the good returns when markets have been doing well, but protected you when markets have fallen. If you look from here to here, the fall was significantly greater than here to here, but the gain from here to here was pretty much the same as from here to here. So that's really what we're trying to do with a diversified portfolio, is get the benefits of the upward market and provide protection in a downward market. And it's those downward times that actually will see you get the best outperformance of a lot of solutions, and I'll come back to that more later on. So the performance of the portfolios in general have looked good, and but that's partly because the FTSE 100 and other markets have been doing very well. So people keep saying, is the FTSE now overpriced? Now that it's through 7,000, it feels like it might be overpriced, and of course at 7,000 it is at pretty much an all-time high, but not in real terms. When we take account of inflation, actually the FTSE at 7,000 is not anywhere close to its all-time high in real terms. And in fact, that's better highlighted by this CAPE valuation rainbow. So you can see that 7,000 back in 99 was bubble territory, but you can see 7,000 now is still actually probably bottom of the yellow one. So it's almost closer to depression than it is to a bubble. So there still seems to be plenty of growth opportunity in the markets as a whole. People feel like it's overpriced, but actually in real terms, I don't think it is. So the next chart I want you to come back to in your investment report is something that hopefully you've become fairly familiar with if you're looking at these reports regularly, but it's something I just want to remind you exactly what you're seeing, because this should be the most powerful chart we can give you. Because everybody always asks us, how much have I put in and how much is it worth? So the black line that runs through this is how much you've put into your portfolio minus anything that you've had back, and the block value behind it is the value of the investments. So that's the true value of the investments. So it's all after fees and costs and everything else. So if you're above the line, and by the way, this is genuine data, it's not a specific client, but it's genuine data that runs right the way back to January 2013, which is when these portfolios were first created. You can see that actually we've had good growth over and above the line. But that will be different for every one of you, and it's worth pointing out that if your portfolio, if your charting has been running, and if you look to the bottom left-hand corner, you'll see how long it's been running. But if your portfolio has been running for less than 3 years, really the data is not so meaningful, because what ends up happening when we look at investment data over a short period of time is it exaggerates the peaks and the troughs. What we need is time for those trends to kind of work their way through the system, so you can see that growth gradually. But otherwise, you can see here that you get troughs and peaks that were probably over and above what we would have expected, and so you just need to have time to look through. So if your performance data is less than 3 years, really focus, look at it obviously, but really focus on what we're looking at on the longer term data as well, because it will be more meaningful. And actually I say that because the growth over the last 12 months has been really good, and I don't want you to expect that that should be the case every year, because it almost certainly won't be. But this chart, everybody always asks us, how much have I put in and how much is worth? This chart is aiming to give you a very visual display of exactly that data, and the different colors relate to the different investments that you've got. So that should be the next place that you really focus on when you open that quarterly investment report. The next page is your asset allocation, and there's two asset allocations on there. There's the target, so that's the target that we've set portfolio metrics given the level of risk that we've agreed with you, and then there's the actual asset allocation. That's the live data from your portfolio. Now these should always look pretty similar. There'll always be a few basis points out, but they should be pretty similar. If they're not, you need to let us know, but we'd normally have picked it up if it's not the case. But what's happening here is that, for example, if we say that we want 17.7% in US equities, and the US equities, US stocks and shares grows really fast, what ends up happening is that your current asset allocation ends up having more than 17.7% in US equities, and as a result becomes higher risk. So what we ask the portfolio manager to do is to rebalance that portfolio at specific times back to the target asset allocation to keep it at the same level of risk. In effect, what we're doing is locking in the gains from the higher risk assets and banking them into the lower risk assets, so that we keep the level of risk the same and we keep the portfolio ticking over nicely. So, and I say that they do that at a specific time. That isn't a specific, it's not quarterly, it's not annually. It's when one of the asset classes moves sufficiently to breach one of their triggers. So it's what's called trigger rebalancing. Trigger rebalancing is a far more sophisticated way of working, and it's something that they can do because they use technology so well. As a result of that, trigger rebalancing is shown to add somewhere in the order of 0.25% extra growth each year just on its own. So it really is powerful, and that's why looking at just sense checking that those two are the same is worth doing. The next page just shows you what the list of investments that you've got. And in fact, the next two pages, one is the pie chart, and one is just the list. That's as interesting as you want to make it. There's some familiar names there and there's some less familiar names, but we can skip over that for now. So the next place I want to look at is your account performance page. Now, this gives you the performance of each of the individual accounts, as you might expect. And there's two reasons why you might see differences in performance. The first is if you've got different levels of risk on different accounts. So for example, if you take more risk with your ISA than you do your pension, or vice versa, you'll see that performance difference pan out here. And the other thing is, if you invest at different times, with different start dates, you will see that affects the performance. So you'll start to see that, if an investment had started here, it will obviously perform differently than one. For example, if one started there and one started there, they're both going to perform differently because one's starting at the top of a peak and one's starting at the bottom of a peak. So this is just really useful to see how the performance is working on the different accounts. But for most of our clients, they'll have the same level of risk on all of their accounts. So actually the next page, the consolidated performance, is a more important page to look at. And what we see here is the navy line that goes up and down here is the performance that you've received on all of your accounts from the date that you the first money went into the first account. And below it, you can then see the rolling period performance, so the last performance over 3 years, 1 year, 6 months since inception. So for example, on this portfolio here, it looks like they've had about 24% if we look at that line there, but we can actually see here they've had 23.7% since inception, and over the last 3 years they've had 22.7% growth. Now your charts should also have an additional line. They won't have the red line, that's just the FTSE 100. I've just put that on there because we've been talking about it earlier. But they should have an additional pale line on them. If it doesn't appear on this chart, it might appear on the copies of this chart later on, which I'm going to come on to in a minute, but it should now appear on this chart. What that is saying is when we first set up the portfolio, we said that it was likely to grow at a specific amount plus inflation. So in this example, you can see it was inflation, CPI, Consumer Price Index, plus 3%. Now that's an important thing to bear in mind, because if I told you that we'd had 25% growth this year, you'd be delighted, or I'm hoping you would be. But actually, if inflation has been 30%, you've done really badly. And equally, if we only get 2% growth, you might be disappointed. But if inflation has been negative at minus 2%, then actually you've done really well. So we need to always monitor growth over and above inflation, because otherwise the data is meaningless. So on your chart, you should see a flat line that shows you the expected growth rate given your specific level of risk plus inflation, and you assume that inflation is likely to be 2%. So in this instance, this would be expecting 5% growth after fees. But as I say, it's 3% over inflation that's the most important thing. Now, as you can see, this has had significantly better growth. What you can also see is there should be these additional chart bars here. So since inception, in order to meet that expectation, we needed 13.7% growth. But in reality, we've had 23.7% growth. So that line there is a good benchmark to keep tabs on, because it's showing you what we expected and what we've actually got. This is also the level of growth that we would put into the cash flow forecast. So if we're above that, we know that the cash flow forecast is currently working on a conservative growth rate. If, of course, we're below it, we may be in long term below it, then we might need to rethink how we're modeling the cash flow forecast. But I'll come on to that later on. So this is the final piece of the quarterly review that I'd really focus on, because here you can very quickly see, is the performance up or down, and what are the numbers associated with that. By the way, remember, if you've got any questions with any of this stuff, please do drop it in the chat box, and I will do my best to answer it. So moving on, so what we've got there is performance analysis that tells us that the portfolio metrics performance has been better than we would have expected compared to growth over and above inflation. And I'm sure you'll agree that 22% growth, 23% growth over a 3-year period does sound fairly good, particularly in a low interest rate environment, which of course we're in. What it doesn't tell us is how portfolio metrics are doing compared to the rest of their competitors. So that's where we need to go next. And we've sent you a separate document with these charts on, but you don't need to pull that up particularly, because I'm going to pull up all the charts now that you need to consider anyway. So we want to compare portfolio metrics against 2 different worlds. The first is the discretionary managers. So that's the likes of, the discretionary managers. So that is people like Coutts, Investec, UBS, the places that we typically took clients to when we're investing £2 million or more. Certainly the most expensive way of investing. And the way that because every portfolio in theory is different in the discretionary managed world, the way that we compare the performance against that is through an independent company called ARC. Now ARC consolidate the data from literally thousands of different portfolios. They give us they put everybody into 4 different categories of risk, and then they give us the average return of those 4 different levels of risk. And then with regards to the fund managers, so that's people like Jupiter, Fidelity, those sorts of people, we want to also categorize them into 4 groups of risk and get the average return that they're delivering. And we want to compare that against portfolio metrics. Now we use this type of reporting quite a lot, so it's worth just making sure you're absolutely clear what you're seeing here. So in this chart, you've got up the horizontal axes, you've got you've got annualized growth, and you've got across the vertical axes annualized growth, horizontal axes you've got risk. Now up and left is good on this chart. In an ideal world we want 12% a year growth with zero risk, but sadly that's not possible. So we've got the purple line here is ARK, so that's the discretionary fund managers. That's those four dots are the four groups of risk. And then we've got the fund-based world, which are these four here on the orange line. And then portfolio metrics are the blue line. What you've got here is this bottom left-hand corner is 1 out of 100 on the risk scale. Top right-hand corner is 100 out of 100 on the risk scale, and then these are 5 dots in between. And we consistently look at these 7 portfolios with portfolio metrics, because we know that if we look at 1 through to 100, we know that every client is somewhere on that risk scale. So again, I've mentioned portfolio 5 earlier because a lot of clients tend to congregate around that. So we'll look at that again. So you can see here that what this is telling us is that portfolio metrics over this time frame gave us around 8.8% growth per annum. Had we looked at the had we been in the discretionary managed world and got the average return, we'd have seen somewhere in the order of 6.5% and probably about 6.2% per annum in the fund-based world. So that instantly tells us that we've had some good growth over the last over that period of time. That's January 2014 through to December 2016, so a 3-year period. Oops, I'm going to skip one too many there. But let's also look at it over different time frames. So we've got that 3-year chart that we've just looked at, but over 2 years, portfolio metrics again look like they've provided much better performance than the average. And really, if we're in line with that ARK average, we should be fairly happy. But certainly if we're beating it, we should be really happy. Now, over the last year, again, still good outperformance. And you'll notice the scale is changing here based on the growth of each year. So the actual outperformance, whilst it's narrower there, is equal to that, if not greater. But what you will notice, and what we've noticed, is that typically when the markets do really well, that gap does tend to narrow. The traditional investment managers in particular, but also the fund managers to a certain extent, tend to do well when markets are doing really well because they tend to have higher risk, slightly less well-balanced portfolios. They tend to have a stronger bias towards UK stocks and shares because many of them are typically stockbrokers. That what they like doing is picking stocks. Whereas when we have a bad year, that's when really portfolio metrics have excelled themselves because the protection they've given clients over and above the other competitors has been significantly better. And really, as I say, that's where the great outperformance can come if you can provide better protection in a downward market whilst good returns in an upward market. So that tells us that portfolio metrics' performance has been really good compared to the industry averages. But we also take, and we do all of this research every quarter, but we also take a whole load of about 30 specific competitors and compare the performance against portfolio metrics for that. So I just want to go through a few of them just to give you a few examples. So again, remembering that up and left is good on these charts, and also bearing in mind that really what we want to see is a good sort of bottom left to top right type arc. What should happen is it should bend over a bit and flatten towards the top, because eventually taking more risk doesn't deliver any more benefit. So I want to see a nice arc and up and left. Now this company this is a comparison against 7IM. So this is Justin Urquhart Stewart's lot, the guy in the red braces that's on the BBC quite often. That's their discretionary management arm. We've then got Legal and General, Old Mutual, Scottish Widows, Standard Life. Standard Life were quite interesting for a little while. This is not always the case across all of these companies. The vast majority of them, the portfolio metrics line is up and left of the competitor. For a little while, Standard Life's lower risk portfolio was doing better, but even that's now moved underneath the portfolio metrics returns. And St James's Place, people tend to know of. You can see their risk control. There's something weird going on here in the fact that these guys were getting significantly better returns than these guys, even though they were taking less risk. So there's something strange happening with their risk control. But as I say, we do this every quarter for about 30 companies, and consistently the performance looks significantly better for portfolio metrics than anybody else we can find. So we wouldn't recommend any strategic changes in terms of the discretionary manager. We're really happy with what portfolio metrics are doing for our clients at the moment. So therefore, it only comes down to, are there any other changes that you want to make to the portfolio? Now, one of those changes that we should consider every year is the difference between active and passive investments. And we can make these changes within the portfolio metrics environment. So what do I mean by that? Well, active funds are funds where portfolio metrics are picking a fund manager who's going to try and beat the market. So they're paying a fund manager a bit more to try and beat, for example, the FTSE 100. Whereas a passive fund is where they're paying a lower cost, but all we're going to do is track the market, track the FTSE 100 in that example. And I suppose the performance difference here is how good are portfolio metrics at picking fund managers that then go on and beat the market, their respective market, over and above the additional charge that we pay for that. And typically the no tilt approach, which is what most of our clients are on, in fact pretty much everybody nowadays, it will be made up of about 75% active funds and about 25% passive funds. And what you'll see is that the blue line, which is the no tilt, so that's their best guess portfolio, 75% active, has delivered quite, again, if we pick the fifth dot, quite significantly better returns than their passive counterpart after charges. But interestingly, not only has the performance been better, by picking active managers, they've managed to reduce the amount of risk you've got, because those two dots are exactly the same asset allocation, exactly the same split. It's just that by having active fund managers, not only have they increased the return, they've also delivered you less risk. So whilst we obviously review this every quarter, and if that ever changes and flips, then we'll be telling you to switch to a more passive approach. At the moment, we think that the no-tilt active approach is the right way to go. So all of that stuff that I've just been through, we look at every quarter, but we also look at the portfolios every month, and this is the mechanism that we do that through. And I suppose there's just two real key things to just bring your attention to here. The first is when we look at this chart, we see what we should expect. 100 out of 100 looks like the scariest ride, but it's delivering the highest returns. The 1 out of 100 looks like a bumpy version of cash, which it should do. So that's reassuring, and that's kind of reinforced by the fact that the more risk we've asked them to take with a client, the more risk the client has got and the better returns they've got. So it just really highlights the fact that portfolio metrics' risk control is probably one of the most important factors, one of the things that they get really well, really right. And as a result, we're really happy with what they're doing from an investment point of view. So there are clearly changes afoot. We've had an unbelievably rocky year from elections and referendums and all that sort of stuff. And I think probably the thing that keeps getting talked about the most at the moment is political risk. That seems to be, everybody seems to agree that that's the biggest risk to our investment money at the moment. And I think there are some things in the year ahead that I just want to touch on, just to be mindful of, because there is risk out there. But I think we can also look back at the last year and say, well, with the referendum and with the US election, we've had a lot of political risk last year, but that doesn't always lead to bad performance. Actually, as you've seen, it can lead to very good performance. And in fact, I was at a big conference with about 1,000 financial planners this time last year, and there was a lady economist. In fact, it was the lady MP, or her husband. She's married to an MP, and she took the speeding points when he got speeding, and they got caught and they both went to jail. I can't remember her name, and had I known that it was her at the time, I'd have probably had the sense to put my hand up and ask an awkward question. But anyway, she was standing literally a year ago, start of January 2016, and was completely doom and gloom. She said that this is going to be an awful year for the stock markets, and I would be taking my clients' money out of the market. And now you can see what's happened, and you can see that, you know, I suppose it comes back to that saying that economists have predicted 9 of the last 2 recessions. So I know of a lot of financial advisory firms that did take that approach and took their clients out of the market because they were worried, and they tended to do it, as far as I'm aware, around the FTSE being at about 5.8. Now, using the FTSE as a barometer again doesn't, you know, accurately reflect everything, but it is a pretty good barometer. My suspicion is, and I'm giving them the benefit of the doubt, that given how quickly the markets moved after the referendum result, they probably didn't get their clients back into the market until it was north of 6.3. So they gave up half of the year's growth because they tried to time the market instead of coming back to the phrase that time in the market is better than timing the market. So it is, we need to be mindful of the risk that's out there, but we still need to keep the portfolio correctly diversified so that we don't miss the opportunities when they come. But, you know, obviously we've got some significant change going on in the US. Donald Trump is firing policies out left, right and center at the moment. So clearly what he does over the coming year is going to influence markets and the confidence that is had around that. That could actually lead to very positive markets, because being the businessman that he is, that's likely to be one of his main focuses, but there's political risk with what he's doing. Geert Wilders is the Dutch potential leader. If he was to get in, he's very much for taking Holland out of the EU. He also wants to ban the Quran. So those elections are happening soon. We've got Article 50, which needs to be triggered by the end of March. So that's going to lead to some volatility around the implications of that. Marine Le Pen, now she's probably got a slightly lesser chance of doing well, but she could well make the second round. And she is very much, again, anti-Europe, would quite happily see France exit. There's some interesting hardliners that will be challenging in Iran, and a combination of Donald Trump and those one of those hardliners getting in could put the Iranian nuclear deal in jeopardy. The Chinese leader is probably going to continue and get more power as of the autumn, and of course Angela Merkel in October sort of time will be finding out whether she can continue on. Some people that are local living in Germany think that she will do, without doubt, but there's a lot of people that are a bit more skeptical about that. And of course she's been the spearhead of Europe, and if she wasn't there, then that would make for some interesting times, and I think she's certainly skating on thin ice. So all of this could lead to very positive markets. I think that we certainly shouldn't be expecting a year like last year from a market point of view, but I think we could quite easily see a sideways or a small growth year, but there really is no telling. So, which is why having a diversified portfolio has never been more important. One thing I want to focus on a bit today is pensions, because there's a lot of change going on there, or has been over the last couple of years, and I think it's really worth touching on this stuff. So there's 2 key allowances that we need to be mindful of with pensions. The first is the annual allowance. That's the amount of money that you can put in each year. It used to be as much as 215,000 in any one year. It's now just £40,000. I would see that now a bit like an ISA allowance. It's an allowance you really want to be using it up as much as possible if you can do. So because what happened when they created a lot more flexibility around how you take the money out of retirement, and they made pension significantly more attractive, what they also did was restricted how much you could access that, both in terms of how much money you get into the pension through the annual allowance, and that annual allowance if you earn more than £110,000, gradually starts to fall to the point where it falls down as low as £10,000. So that annual allowance really is something that you want to maximize if you can do, but being mindful of the lifetime allowance. The lifetime allowance is how much money you can have in the pension without triggering an additional tax charge, and it's quite a chunky tax charge. It's 55% tax if you go over the lifetime allowance. Now that lifetime allowance used to be as high as 1.8 million. It's now only £1 million, so it might sound like a lot of money, but particularly if you're a few years from retirement, then that it's quite easily achieved. It's not a huge amount of money. It's certainly in a pension anyway. So you just got, I would say that these pension allowances are really, really valuable. You really want to maximize the opportunity you get, but you don't want to put more in than your own annual allowance, and you don't want to be sailing past the lifetime allowance, because at that point they become much, much less attractive. But why do I say that they are so attractive? And by the way, I think that they are probably the most tax efficient wrapper now to use, certainly for a higher rate taxpayer. Well, one of the reasons is their inheritance tax treatment now. So if you died with money in drawdown more than a few years ago in your pension, you paid up to 82% tax. Well, nowadays, inheritance tax, that is, or similar to inheritance tax on death. If you now die with money in your pension fund prior to age 75, that can pass to your next generation free of any tax, free of any inheritance tax. If it's after age 75, then it's liable to tax at the recipient's rate. Now, if we compare that to you drawing the money out, what typically happens is if you draw the money out of the pension over and above your tax-free lump sum, that's going to be subject to income tax at 20 or 40%. And then if that money's in your estate when you die, it's subject to another 40% inheritance tax. So you could end up with your children getting 20% of those drawings from your pension. If, however, you leave the money in your pension and you die before 75, they get the whole lot minus zero tax. And if it's after 70, if you go after 75, it is likely to be at something like 20 or worst case 40% tax. But they've got much more control over how they manage that. So I would see those ISA and pension allowances, but also the ISA allowance as well, very put them in the same category and say, look, you really do want, people have been quite well trained from a psychological point of view to try and fully fund that ISA each year, because it is a valuable tax break. But I think we really need to think about the pension allowance in the same way nowadays. And if you can fund that pension allowance, and in many instances I've seen people taking money out of ISAs and putting into pensions because, particularly I've seen a number of accountants doing it because the tax breaks for the pension are so much more attractive. So really think about how you can use up those allowances as much as possible, but without going over them and over the lifetime allowance too. Now, I've spoken to a number of you about estate planning. So what happens if you die, and how do you ensure that what you want to happen to your money does happen to your money? And sometimes it's less important than the financial planning, so sometimes it kind of gets put aside. So I thought it'd be worth just going through and just reminding you the benefit of estate planning. For those of you that have already done this, it'll be a good reminder as to why you've done it. And for those of you who haven't, it will be a good process to go through to think about whether you should be doing it. Now, I'm not going to go through the full chart, but if you die without a will, it does get pretty messy. And what you wanted to happen to your money doesn't necessarily do that. So how can we do something different? Well, the first thing we need to do is to think about installing a trust framework. And why would we do that? Well, obviously we need a will. A will determines what happens on the day you die. But the problem is a will on its own is just usually not enough, because what typically happens is when something happens to the first person, they leave everything to their spouse. Now they want to leave it to their children next. But what happens is if the surviving spouse gets remarried and then dies, then that money can disappear off to the future husband or wife. If they get remarried and then divorced, that money can disappear in a divorce settlement. If they go into a care home, then that's all liable to care fees, and they won't get any help from the local authority until such time as all of the house is sold and spent. And as and when they leave it to their children, obviously it's all in their estate from inheritance tax purposes, but even once it gets down to the children, if the children were to get divorced, then that hard-earned money can disappear off to the daughter or son-in-law from hell. So what's the alternative? Well, if we install a trust framework in place, then on first person's death, we can start to leave some assets to that trust. That trust, if we do leave stuff to the trust on the first person's death, and that might be a share of the property depending on the situation, that's still available for the spouse to do whatever they want with. So that could be downsizing the house, even if half of the house was now owned by the trust. It doesn't stop them doing what they want with their money, but it does start to ensure that if, for example, that person gets remarried and die, or remarried and divorced, then at least that share of the estate is known. It's going to come back to the trust and go down to the children. So it's protecting some of that estate. If the survivor ends up in a care home, then half of the house is now owned by the trust, and that is likely to protect the some or half or even the full value of the house from care fees. And also, if there's a big distance in time between the passing of these two, there can be some inheritance tax savings as well from this. But as and when the children come to take the money out of the trust framework, then what they would do is they'd take that out as an interest-free loan. And the benefit of that is that if they were to get divorced, then that money is a loan from the trust, so is not forming part of their estate. And equally, if something happens to them or they want to pass that money on to their children, they can return it to the trust, and the grandchildren can take it out as an interest-free loan, thus protecting that from inheritance tax for a second time. Because the inheritance tax savings between this generation and the children aren't huge. There are some trusts that we can install in here that can create some bigger inheritance tax savings for larger estates, but having the trust framework has the opportunity to save huge amounts of inheritance tax between that generation and the grandchildren. And think about this not just from a situation of you guys being at this point, but also if your parents are still alive, then think about it from this point of view as well. Can you do trust planning to allow your children to benefit free from inheritance tax from your parents? So just think about it, because that trust framework has the ability to save quite a significant amount of money in inheritance tax, divorce, and care fees. And as a reminder, if you've got any questions throughout, please drop those in the chat box, and I will do my best to answer them as we go. So one of the things that we need to cover in this review is a review of your level of risk, the level of risk that we invest through. And so what I want to do is I want to just show you how the portfolio changes with different risk levels. Now, in your investment report, what I should have pointed out actually, and I forgot to, was that if you continue through that investment report, you will see that it's longer than the traditional one that we send you every quarter, because what we then do is we break each separate account down and we give you those same charts, but for each individual account. Just gives you more clarity on what's happening with different accounts, but also it allows, if you've got different levels of risk, it allows you to see different expected returns. But the other thing it allows you to do is at the start of each subsection for each of the separate accounts, and I think this is likely to be on about page 21 onwards, you will see the risk score that your specific portfolio is at. So it's a reminder of what level of risk you're at. But you can see, as we've already looked at, that the more risk that you take, the more risk that you receive. The bumpier ride, the rockier, the roller coaster ride gets more and more bumpy. But so far, and over the last 4 years, and historically, that usually leads to better returns. But it does mean that you end up with bigger falls throughout that period as well. But I just want to show you what portfolios look like at different levels of risk so that you can make more of an informed decision as to whether you do think you want to change your risk level for any reason. And if we think you should, we'll have put that in the recommendations of your pack. But if you want to change it for any reason, then of course you can do. So 20 out of 100 looks like, it's got nearly half of the money is in cash and stable assets. You've got probably another third in bonds. That's bonds. So corporate bonds are loans to companies. Government bonds are loans to governments. And then you've got just less than a quarter in stocks and shares. And that's likely to deliver around 2.62% plus inflation. If we go up to a 40 level of risk, you'll see the cash and stable assets has now fallen. Actually, the bonds has risen probably slightly, and the stocks and shares is, of course, rising, and we're expecting now 3.42% growth. If we go up to 60 out of 100, you can now see we're expecting 4.15% growth, and we've nearly lost all of the cash and stable assets. We've still got a bit over a quarter in bonds, but over half is now in stocks and shares, including nearly 10% in emerging markets, and we're starting to see some global property coming in as well now. And then finally, if we go up to a level risk 80 out of 100, you can see that all the cash and stable assets have gone. The bonds are now less than, probably about a third. You've got a bit more global property coming in there, but the equities as a whole is gradually becoming more and more of the portfolio. We're now expecting 4.79% growth. Now, in your packs that I'm going to ask you to complete later on, there's some questions which relate to this risk level, and so if you can indicate whether you would like to have a conversation or would like to change your risk level at all, then that would be brilliant. Now, one of the other reports that we've sent you is your latest lifetime cash flow forecast. And what I would do is I would skip to the last two charts of that, because those two charts are the ones where we eliminate the inflation from it. And there's two key charts that we refer to. And so I just want to remind you what those are and what you're seeing on your chart. Now, these two are the same chart, but in different client situations. So this is the income versus expenditure chart. And you can see this black line here is your expenditure that goes through it. And these blue blocks are the income available that year all the way through to age 100. So you can see this person's blue income bars aren't sufficient to get up to the expenditure in later life, hence the red. So the red is highlighting the fact that this person is on track to have insufficient income later on in life. This person, expenditure doing that, but they've got blue blocks all the way up to the black line, so that means they've got more than enough income to meet their expenditure right the way through to age 100. The second type of chart, which you will see from your document, is the liquid assets chart. And these two are the same situation as are these two. So this is essentially what's going on in the background. This is the income and expenditure that's available for each year. This is the value of investments in each of those years. So you can see this person has insufficient income later in life because they've spent it too quickly and they've only got a small amount of assets left. Whereas this person has more than enough income for their needs because in fact their investments are rising throughout. Now that person could actually be spending more money during their retirement if they wished, and still have enough. One of the things that we're finding is that clients don't think to use this as much as they should do. So if, for example, you have a life-changing event, you're going to sell a business or buy a much bigger house or whatever it is, then by all means use us as a resource. Phone us up, send us an email and say, I'm thinking about doing this. Please could you just model model that as a what-if scenario in our cash flow forecast, because it will just give you a better understanding of the future implications of the decisions that you make today. And Tim is always in the office, and Tim is extremely capable at building cash flow forecasts. And so whilst I'm not in the office all the time, he will be able to help, and some of the other team as well, but particularly Tim at the moment will get involved in just tweaking any of this and sending you a new version of this if need be. If there's something life-changing happening, then this can really help. So please do use him as a resource. and use the team as a resource actually. And it also allows us to plan more smartly, because historically we used to expect flat incomes in retirement, but that was for me a bit daft, because it assumed you were as likely to climb Kilimanjaro at 95 as you are at 65. Well, we all know that's nonsense. You're much more likely to do the crazy, outlandish bucket list type things at the start of retirement. So we can therefore build what's more like a bucket list income. We can think about delivering higher levels of income during those early years, and then as you kind of get the crazy things out of your system and they become a bit less crazy and a little bit less frequent, we might want to do them every so often. And then you might find that gradually, as you kind of get older and older, you leave the house and the country less, and as a result you need less income. So we can be much smarter around building an income and a dynamic income that really delivers the retirement you actually want, rather than just this flat income for the rest of your life, which has historically been the case. And again, we can also start to be a bit smarter and say, how can we use that cash flow forecast to really help us plan better? So I mentioned earlier we really want to preserve those pensions, and in fact I perhaps didn't emphasize the point enough, but really one of the things that we want to do is, because the pension is now even more valuable than it is, we really want to spend the money that's in ISAs and other investments as and when you get to retirement, and preserve the money that's in the pension generally as long as possible, because the money in the pension is not liable to inheritance tax, or is liable to less than the money that's outside of it. So for example, this person, the brown on here is pension, orange is investments. This person is spending the pension but allowing their investments to rise, which is all very well and good, except all of that is now going to be liable to inheritance tax. Whereas this person has spent the investments in cash, preserved the pension, and whilst they've got pretty much the same amount of money left at the day they die at age 100, this person can leave it all free or at a reduced rate of inheritance tax. So it does allow you to plan much, much more effectively. And this is another example of inheritance tax planning using it. So this was a trust. The purple is a trust. The green stuff was all the investments that were in their estate and liable to inheritance tax. So we had them spending the green stuff, preserving the money that's in the trust, and allowing that to grow, so that on the day they die, whilst they can still draw an income from this if they need to, which in this instance they probably would, by that point all of the money is outside of the estate for inheritance tax purposes. So really look at your cash flow forecast, but this also comes back to, I said earlier, we let you off if you didn't fill out your preparation pack. When you're doing that, think about what scenarios you might want us to model, because one of the benefits of filling out that preparation pack is you can say, well, what would retiring at 60 look like? What would retiring at 65 look like? Really let us model those situations for you, and so that when you're in this review workshop, you can really see the cash flow forecasts that we've modeled for your specific situations that you're considering. So I now wanted to tell you about two new exciting portals that we're going to be rolling out for our clients. Now, at the moment, you can log into WealthTime and get a valuation, and you can get the important documents there, but it only has the WealthTime documents, and the performance is so bad, the performance reporting is so bad that we tend to turn it off for clients, because it just creates more confusion than it helps with. But one of the things that we've been doing over the last 6 months is rolling out a whole new back office system, all the system that we keep all of your client data on, all of those sorts of documents. And as a result of that new system that we've installed, we're going to be able to roll out a new client portal. So I've got a short video that shows you a little bit about the back office system, and therefore actually the video is only about the portal, because that's the bit that you guys will see. So I just want to show you a quick video that shows you the benefits of this portal that's going to be coming your way.
Attitudes to online finance are changing. We're all much more familiar with online banking, and researching and buying insurance products over the internet has become the norm. As consumers, we increasingly want to interact with our financial products and advisors across multiple channels. face-to-face, by phone, online, or a mix of all three. Exciting advances in technology mean that it is now possible to view all your short, medium and long-term finances in one place at the touch of a button. Imagine being able to see your entire net worth in one place. That place is called the Personal Finance Portal, or PFP, made available to you by your financial advisor and accessible online 24/7 on your desktop, laptop or mobile device. PFP is a single powerful financial management hub which gives you access to your long-term savings and investment information in an easy-to-use online format. Additionally, PFP Premium allows you to combine this with short-term bank account and credit card data, as well as loans and mortgages. Accounts, transactions and balances are refreshed every day, so you're always up to date. And we show them in a visually engaging way that's really easy to understand. This means that you can see all your financial information in one place, an invaluable one-stop shop, to give you an overview of your complete financial situation, including up-to-date portfolio valuations, whenever and wherever you need it, and see how your investments are performing and whether you need to discuss matters with your advisor. It is also encrypted and completely secure, meaning that you and your advisor can communicate safely. No more emails or posted documents which can be intercepted. With PFP Premium, you can preset savings and investment goals and set up alerts to let you know whether you're on track or need to address a shortfall. You will receive useful insights into your spending habits, so you can always be on top of where the money's going. And it's good to know that your bank account and credit card information is totally secure, protected by bank-level security. You also have the peace of mind of knowing that your information is read-only. PFP allows you to house all your financial documents in the online document vault, which is completely secure and fully backed up. More secure than keeping paper copies in your home filing cabinet. So why not let the Personal Finance Portal help you manage your money more effectively? Ask your advisor for more information today. Change is good, but only if you're part of it.
So that portal will go live in probably around 2 months' time. So look out for an email about that. One thing, so where we see this as the main portal that people will use going forward, we'll be able to keep your online, we'll keep your documents there for you online, and we will start to use the secure messaging more and more to communicate with you, because in this day and age where people's email accounts are getting hacked, it's vital that we communicate with you in a secure fashion. It also mentioned the IntelliFlow premium pack, or the portal premium version. That's where you can pull in data feeds from existing bank accounts, mortgages, loans, so that you can genuinely see all of your investments all in one place, which is a really powerful view. For that premium version with the bank account fees, there is a small monthly cost for it. I can't remember exactly what it is, but it's sort of like £2 or £3 a month. As a result, if you would like to, as and when we get to the point where we roll that out, you are able to upgrade that to the premium version. In addition to that, will be where we think most of our clients should be logging in most of the time. But in addition to that, Portfolio Metrics have also launched their own portal. And as a result, if you want to log in and see live versions of these performance reporting charts that you're becoming familiar with in the reports that we're going through now and the ones that we send you quarterly, then you will also be able to log in and get access to that there. Now, I appreciate having 3 portals might cause some confusion, so we're going to put together a page which says, right, if you want this, this and this, go to this version, this portal, this and this one, and etc. Not only that, we also, when we send out the details of these portals, recommend a piece of software where you can manage your passwords securely, so that you don't end up with 3 post-it notes down the side of your monitor instead of just the one. So look out for those. They should be, I think they should become really valuable tools as time goes on. So in your pack, there are some investment decisions and also some recommendations that we would like you to make. We're going to need those forms back from you because this is the webinar version. Obviously, once we've finished this talk, if you strike while the iron's hot, if you can complete those for us and then email either scanned copies back or post them back to us, that would be brilliant. We will chase you if we don't get them because it's really important that having made these recommendations, we know whether you want to action them or not. If you've completed the pre-review questionnaire, your recommendations will be a bit more specific than if you didn't. If you didn't, then obviously we're working on the knowledge that we've got of you from previous years. But it is really important that you send those back, and there are some key recommendations in your pack where we see that there is some opportunities to improve things. I just want to highlight something that's coming up. So for those of you that have read some or all of my book, you will know that the Dream Retirement side of the business is more about, half of it's about the money side of retirement, but the other half is more about how you can spend a happy retirement and how you can continue to improve your health and well-being. So that's your body, your mind, and your relationships. And so what we're going to be doing in over a 2-day event at the start of April and also again in October is what we call the Dream Retirement Masterclass. And that is, as I say, it's a 2-day event, Saturday and Sunday, where we can spend time with clients really working through some of these exercises. Now, I'm the sort of person that attends a lot of workshops and I read a lot of books, as you know from the newsletter. I find that if I read a book, I action maybe 20% of what I learn, probably only 10%. And I think research shows that it's usually about 10%. If you in a workshop environment where you are listening, learning, interacting, and then doing, you implement more like 70% of what you learn. So it really does make a huge difference in doing it in that format. So look out for some invites to that. We'd normally charge £597 for a ticket to this, but because you're a family client of Efficient Portfolio, we'll be offering you tickets for free. So if you would like to come along, please do, because I think you'll get a huge amount of value out of it. The people that have given me feedback on my book, the people that have done the exercises as they've gone through have given me 10 times better feedback than the people that just read the book on its own, because really it's about us asking you the right questions, and that's how we will facilitate that and help you create your dream retirement. So look out for that. One thing that I'd be interested to see an email from you on is an idea that we're toying with introducing in the future. It's something that we have a monthly meeting called an energy meeting where we're working on the business. We have a weekly meeting on a Monday morning between 10 and 11:30 where we're just working on stuff in the business, but once a month we have an energy meeting where we're working on the business and working out how we can get it better. And we're toying with the idea in the future of installing a financial concierge service. So somebody that would help you with things like your general insurance, so household insurance, car insurance, travel insurance, making sure you're on the cheapest energy provider, all of those sorts of things. So I'd be interested if you could email me or the team just to let us know whether you think a financial concierge service would be of use to you, either to save you money because you're not making all these switches yourself as you should be, or to save you time because you are doing all the switches, but the huge amount of admin that comes with it is really quite a chore. So if you could email us any feedback about that or put it on your forms, then that would be appreciated. So next actions. You've got the investment decisions and the recommendations bit. Please do read those through, answer the questions, feed them, fire them back to us. And also on that form, you can indicate whether you need a one-to-one meeting, when you need it, and what we need to cover within it. So please do complete those and send those back to us. Next year we're probably going to get, or we will get you to do a new behavioural finance questionnaire, because it's good to do that every few years just to reassess your level of risk. So look out for that. And because this is a new approach for us, the Client Review Workshop, I'd really welcome if you could give us some feedback on the content, and also because you're watching this as a webinar version, this format, how this format has worked for you. So if you could please send that back to us as well, that would be fantastic. One final request is that we would love some testimonials on your experience of this Client Review Workshop, just so that we can use it as an example of how clients are benefiting from this particular approach. So if you would be so kind to write down a few lines just to tell us what you thought of it and what we could make better, because if we can make it any better, that obviously we will try and do that. But anything that you can do, or any feedback that you can give us, would be really appreciated. Any testimonial you can give us would be really appreciated. But even better, if you want to do a video testimonial, use your smartphone to video a quick message as to what you got from this, and send that to us. That would be even better, but I appreciate that involves a little bit more work. But anyway, that is me done on the Client Review Workshop. I'm going to fire out 2 questions. I'll open the chat up again in case anybody's got any questions. If you haven't, please just send back the recommendations and investment decisions section and the feedback. With regards to one-to-one meeting, once we know a little bit more about what you think works best for you from a time point of view, then we'll book that one-to-one meeting. And that one-to-one meeting, now that we're doing so much of this performance stuff beforehand, can be in whatever format you want. So for some people that might be a telephone call that is 15-minute chat about risk level, or should I increase the amount of money I put into my pension, or increase the amount of income I take from my investments, whatever it is. And that can be the idea of doing this approach, is that that might sometimes now be 2 telephone calls instead of 1 face-to-face meeting, or some years we might need a face-to-face meeting or 2, and then other years maybe not at all. So we can now be a bit more dynamic because we're delivering these important messages through a more effective format. So if there is any questions, please fire them into the chat box now. If not, I have got some trust questions that have popped up, but they're not in the chat box, so I hadn't seen them. Apologies. So scenario when holding a trust framework, if the remaining spouse holds ends up in care, 50% of the fees protected in the trust. So 50% of the value of the property is protected from the care home, but actually care home fees. But actually, probably, and current the way it's working, is 100% of the property is being protected, where 50% of it is owned by the trust. And that is simply because the local authority can't force the sale of a property where the person going into care only owns half of it. The trustees own the other half of it, and so as a result, probably the whole value of that property is protected from the care fees. The second question was that the risk level performance of inflation. Please remind me if this is after fee. Okay, so all the performance figures that we were talking about, with one exception, were after fees. The only time that we were talking about performance before fees was when I was looking at those different examples of risk levels, like 20, 40, 60 and 80. And the only reason I picked both figures were on the screen, but the only reason I picked the pre-fees one is just because that's just what I picked. Both were on the screen, and I picked the before fees growth figure. Any other questions? I can't see that there are any other questions. If you have finished and you're happy with, if you've got any questions you want to ask me directly, then obviously email us and we will come back to you on that. And otherwise, it just leaves me to say thank you very much for dialing in. I hope you've got lots of value out of this. We do these as face-to-face workshops. I was doing one at 2 o'clock this afternoon, and as webinars. I appreciate for some people it's easier to dial in for the webinar, but the group workshop is a very different experience, and so it might be worth trying both to see which works better for you. But I'm delighted that you've dialed in. And if you've got any other questions, please email us. Otherwise, thank you very much. I will let you enjoy your evening.